We're watching financials this morning as this market sells off. Deutsche Bank under pressure. Take a look at this. It ended another year in the red. The stock is down 5.3% after reporting a loss of nearly $3 billion. It was hurt by the U.S. tax law and a decline in investment banking. We want to look broadly at the sector right now. It had a pretty strong showing in the fourth quarter. Joining us right now to talk about financials is Neil Dhar. He is PwC U.S. Head of Financial Services, and it is good to see you, Neil. Thanks so much for joining us.
Thanks for having me.
We've been looking at the financial services sector on the runway there. And when you look at regulation, the fact that we haven't seen really the regulatory rollback hit the banks yet, do you feel that we are entering a period that is positive for the banks? Because I feel like the rollback in regs coming, higher interest rates coming, it's going to help net margins and economic growth. The Atlanta Fed talking about 5.4% growth. That has to be a good recipe for the banks.
As we talk to our clients, I mean, generally speaking, I think the banks do feel very good about the marketplace as a whole. They had generally a pretty good earnings season. The banks are going through a lot of different changes in relation to moving a little bit more to wealth management and more stable type of fee. They're going through their own changes in relation to what businesses they want to be in. They're going through transformation in relation to the digital labor and sort of how they change their workforce and how banking's done. So much of banking is now done online, and so they're going through massive changes and absorbing.
And yet, a number of CEOs have told us on this program last couple of weeks that they are entering a period that looks pretty good. Watch this.
We haven't really seen it yet in financial services because the new people just put in place. But the American public should think of this as a vast bureaucracy, which is like sand in the engine. And to reduce some of that, not roll back good regulations, not go back to the good old times, we need to protect consumers, but bureaucracy is bureaucracy. And the American public knows it when they go to the DMV. Veterans know it when they go to the VA.
And team in Treasury, working with the industry and people who like the industry and people who don't like the industry, came up with a roadmap to appropriately rebalance the regulation. As one of the largest underwriters of the FDIC fund with my other banks, we put in the money. We have the highest interest in the safest and soundest banking industry.
There was a lot of rhetoric that was very negative to the business community and a lack of understanding, I think, what powered an economy. And this type of rollback, which isn't everywhere, it's not irresponsible in toto, is really creating, enormous energy and enthusiasm, and is actually an example to people around the world of how you get an economy going.
And yet markets are selling off this morning. So connect the dots. What's going on?
Well, what we heard there is optimism. Optimism in relation to the broader sector in the long term. I think what we saw in the marketplace this week was there was a lot of different news coming out in relation to there was a bit of a spike, obviously, in rates. We're going to see what happens, obviously, with broader interest rates over time. The market had a great run, obviously, for a while. So I don't think it's anything unexpected in relation to what we saw this week.
So the financials also sold off this week, though, even though interest rates went up, and they should benefit from higher interest rates going forward. So how do you see that playing out over the course of the year, and where do you see interest rates going, or where do the banks you're speaking to see interest rates going longer?
I think what will happen with interest rates is if it does, if the Treasury rate, the 10-year Treasury rates go over 3%, I think you're going to see some level of increased volatility in relation to the marketplace as a whole. But I think generally speaking, the bank sector itself feels pretty good about what's going on.
Well, what's good for the consumer is good for the banking sector. And is it not? With people are finally getting higher paychecks. They're seeing more in their paychecks starting this week because of the tax reform. Home ownership last year up for the first time since 2004. And that was in large part because of millennials buying homes. So you actually see those younger people taking part in this economy as well.
That's right. And I think generally speaking, again, that optimism is creeping into the broader markets. And I think the tax reform, actually, now it's about a month, 5 weeks in, you're starting to see now what that means for Main Street along with sort of broader business in relation to what's going to happen.
Really quickly, Neil, are community and regional banks feeling as good about things as we're seeing the big banks talking about? Because that was really what the election was about, helping those smaller banks at the regional level get out from under regulation.
What we're seeing with the smaller or the regional banks is there is more of an M&A appetite in relation to consolidate and do things on a more efficient basis versus the larger banks are trying to figure out which businesses they want to be. So it's a bit of two different worlds in relation to what's happening there, and I think you will see more activity with those banks in relation to consolidation and kind of working through what's most efficient for that marketplace.
What kind of a year are you looking for?
For the financials?
Yeah.
I think it'll be a good year for the financials in relation to, more broadly speaking, the momentum that's been carrying through with tax reform and general enthusiasm with rolling back regulation.
Neil, thanks so much.
Thank you.
Good to see you. Thanks for your insights. Neil Dhar there.